Welcome to e-learning with Divine Public School. We are continuing with the chapter Banking and Monetary Policy. Now, in our second lecture, we are going to study about the functions of commercial bank. As we have already seen the classification of bank, that is central bank and commercial bank, and we are going to start with commercial banks functions. Now, we have seen the list of commercial banks functions, that is primary functions, that accepting deposit, providing credit facility, payment and withdrawal facility, credit creation, interbanking transactions, and the secondary functions like agency and utility services, and provide various facilities with changing times. So these were the primary and secondary functions which have been given by the commercial banks. Now let's start with the primary function first, that is accepting deposit. Now what does deposit means? Banks accept money from the people in the form of deposit. Why in the form of deposit? Because they need to return it back, because whenever the customer demands, they need to return that money back to the customer, as we have learned in the definition itself. So you find that banks, they try to give back the money to the people whenever or wherever they want. Second, you find it gives safety. Why people try to give particular money or keep their money into the bank? Because it gives safety to their deposit by acting a custodian, by taking care of that money. So banks acts as taking care of the funds which people try to keep into the bank. Third, people lend their savings into bank because you find that they give them interest, because they will get interest. That's why you find that the they try to keep their money into the banks. Because if you keep the same money in your home, it does not give you any interest, but when you keep into the bank, you get at least some sort of interest at the end of the year. So this is why people try to keep their money safe into the bank, so that they get their safety also, as well they get interest also. Now, there are mainly three types of deposit. First is current account deposit. Now, we have heard the current account. Now, what does the current account means? Current account is an account which has been this service or facility has been given to the individuals, businessmen, firm, partnership firm, different organizations who want to have their transactions. For them, you find that current accounts are been there. They cannot go with saving account, because current account is required for all the official businesses, every legal thing. So current accounts are being prepared, and in that, why? Because they help us to do transactions every now and there. Number of times there is a deposit, and number of times you find withdrawal purpose is been done in a particular day. So for that, current account is been prepared. In that current account, we can try to go with number of times withdraw the money, or number of times we can deposit the money into the bank. So this is why current account is there, and it is for mainly business purposes. Now here, interest is not given on current account. The money which we deposit into the current account does not gives us any interest, but as we are doing many transactions, some penalties are being taken, or some charges are being taken up if we exceeds the transaction in a particular day. So this is how it's happening up. Then after, saving account. Now what is a saving account? That is, you, me, your parents, everyone keeps their money safe into their saving account. So saving account help us to give us safety for our money, as well as it gives us a particular rate, at a small rate of interest every year. So you find that every 3 months, not every year, but every 3 months, you have some certain interest credit to your bank. So 4% is the interest rate which has been given to us by the saving in our saving account by the bank. So you find that people will try to go with this particular saving account, so that they get certain amount of interest, and they feel that money is been safe, and whenever they want to withdraw, they can withdraw from this account. That's why the interest rate is very less. Thirdly, fixed, or we can say long term deposit. Now fixed or long term deposit means, we can say, for a longer duration of time, you want to keep your money safe into the bank and without withdrawing it. That time you try to go with, like we can say, FD, fixed deposit. So you try to keep your money till 5 years, 10 years, you find 8 years, with that higher rate of interest you can achieve, and so that you find that you can get even double the amount in 8 to 10 years. So this is how the interest rates are been there, which help us to keep into the more in FDs. So this is how common people try to go with this FDs. More of the people, those who have surplus money, excess money, they try to keep into the FDs and they earn the interest and they run their whole life on the interest only. So this is how fixed and long-term deposit are been there. But there is one more type that is under this deposit, long-term deposit, that is recurring deposit. Those who are not capable or not having large amount of money, what they try to go with putting their every month saving into the deposit. So fixed particular date, a fixed particular amount is been kept for a longer period of time, like 3 to 7 years. So that becomes a recurring term deposit. So recurring accounts are being created, recurring term deposits are being made by the small business owner peoples, so that a small amount of money which they save is being kept into the account and they get a higher rate of interest in recurring account, because every month they have to pay that particular money. So then only they can maintain that and they can get high rate of interest. So this is all about the deposit or money which we try to keep into the bank. So you find that current account, saving account, and long term deposit or recurring deposit is also there. And people try to go with why in banks, because they get interest, different rate of interest are being given on their money which they deposit. And why it is deposit? Because they can withdraw money whenever they want from the bank. Second is providing credit facility. Now credit facility means what? Loans. That is, whenever you want to have borrow some money, when your friends relative does not give, you can get that money from where? From the bank. So here, when an individual, or we can say our investors or farmers or any other professional require money for their personal or investment purpose, they can borrow this money from banks and bank will provide them with charging interest on it. So a rate of interest is being charged on them, and this is how bank try to earn money from the people who require funds. So they will give us money, interest also. How? Because they will earn from here and they will give to us. Now again, you find that credit or borrowing can be given for short term, that is up to 1 year. So loans can be given for within 1 year or for 1 year, up to 1 year we can say. So that is short term loan. With loans which are given from 1 to 5, that is called medium term loan or medium term credit. Then after, loans which are given to 5 to 15 years, that is long term loans or long term credit. Now even some cases more than 15 years also you get your loans, depending upon the circumstances and situation or which type of loan you are taking up. So this is how you find that banks, from our deposit, they will try to lend the money to the different individuals and they will charge them high rate of interest, and from there they earn money or they earn profit. And it can be given for different time periods, like up to 1 year or bit from 1 to 5 years or 5 to 15 years. So this is how you find credit is been created. You find that even they give for personal reasons, agriculture activity as well as business activity, with different rate of interest. With different rate of interest, you find that this credit can be given up. So this is the second facility, or we can say second primary function of the bank. First is to take money from the people in the form of deposit. Second, they try to lend the money in the form of borrowings or loans to the person, those who are needed for personal or businessmen or investment purposes. Third facility, that is payment and withdrawal facility. Now how we try to pay or how we try to withdraw the money from the bank? So that, let's see, the bank gives us easy payment facilities to its customer in the form of check. Like if you want to go with payment of money from your account to and someone else's account, you try to go with check. So you find that in the school, many of the school, they try to take the checks because the high amount of money is been, so they try to take the checks. So your parents must be, from your bank account, they will prepare, they will write institution name, date, everything they will fill up, and they will try to pay the money of your fees money in the form of check. You find withdrawal slip. Whenever your check has been finished and you want to use that money, you want to withdraw the money for your own purpose, you try to go with withdrawal slips and you can get the money from the bank in the physical, or we can say cash form. Then after, drafts from one place to another place. If you from one city to another city, if you want to transfer the money, you want to transfer the money with the same bank, that time you find drafts are being used. Then after pay orders are being used. So ATM facilities, everywhere you find different banks ATMs are available, so that any person those who want money, they can just withdraw money from there by putting their debit or credit cards. So whenever they want, when bank is closed but they require money, they can go with ATMs and they can withdraw the money from their account. Then after internet banking, if suppose this all things are not there, internet banking, by putting their net banking ID, password, everything, and they try to go with using this particular, by using applications or online websites, official websites of their particular bank, to transfer the money from one customer to another customer. So this is how you find that withdrawal or payment facility is been given. This is when you have your money into your bank account. Then after fourth point comes, that is credit creation. Now credit means loan. So how loan is been created, how credit is been created by bank. First point says that bank creates money from existing stock, that is deposit. Means banks, those who take deposit from the people. Now what is their stock? That is, their stock is nothing but we say money. So how they will earn from that money? They need to lend that money. Now how they lend? They try to go with creating credit creations, like they try to go with creating more money by giving more of loans. If they create more of loans, more supply of money will increase. Yes, if you try to give someone loan, those who does not have money, by just taking their home and some of the documents, and they try to give you loans, and by that help you try to go with investing your money, using that money for different purposes. So another person also will get that money. Like, so for example, you have taken loan for purchasing shares. So now you have taken loan from the bank has given you money virtually into your account. Now that same money you will go with purchasing the shares. So that shares can be purchased and you have to pay that money to the shareholders. So this is how that particular money goes on. So you find that supply of money increases. If the credit creation is less or credit creation decreases, what will happen? The supply of money will reduce in the market and money is less in the market. So bank cannot lend the full amount here. Every now and then the deposit which we kept, the full amount, suppose we have deposited 1 lakh rupees, the bank will not give 1 lakh rupees as a loan to another person. No. So they have to maintain certain reserves. So for every deposit, the bank has to keep aside certain proportion of money, some portion of money from in the form of cash. It is should be in the form of cash only. So cash reserve, which is known as cash reserve ratio. Okay, suppose you have deposited 1 lakh, so from in that's the CRR, that is cash reserve ratio, is 10%. So 10,000 is kept aside and 90,000 is been used to create loan. So this is how the rule of the bank is there, and this is how they try to create money out of giving loan. So from 1 lakh, 10,000 is kept into the form of cash in the bank, and remaining 90,000 is been used for giving credit facility to the other person those who need. Banks lend the remaining money only. So only remaining monies are being lent for creating credit. Now let us understand this with the help of example. So if a bank has deposit of 1,000, a person A has deposited 1,000 and the cash reserve ratio is here 20%. So 1,000 into 20%. So 200 rupees will be saved or will be in the form of cash by the bank. Now what's happened then? You find that how credit creation works. The formula is here. You find that 1,000, that is the primary deposit, into 1 upon CRR. CRR is nothing but we can say 20% here. So primary deposit into 1 upon CRR will give you how much credit will you create in the money, or how much money will be supplied in the market. So that is 1,000 into 1 upon 20. 1,000 into 1,000 only, divide by 20%. So 1,000 divided by 20%, you will get your answer, that is 5,000. Now if it is said that the new credit will be 4,000, because 5,000 from that, what is the CRR will be kept 20%, that is how much? 1,000. So 5,000 minus 1,000, that is 4,000 of rupees of credit is being, or loan is being created by the bank. Let us more clearly understand with the help of table. A person has given 1,000 into his bank and bank has kept 200 rupees, and that is as per rule, that is 20% they have to keep. So from 1200 is been deducted, you find that 800 is been left. Now this 800 loan is being given from one bank to another person, that is B. So B has now 800, bank he deposit into his account, another bank account, and that bank will keep again 20%. So 800 into 20%, that is 160 rupees has been kept by them. Now 800 minus 160, remove this. So how much money has been left with the bank? 640 rupees has been left from this 800 rupees, and 640 rupees has been given on rent, or sorry, on as a loan to another person. So C will have 640 rupees. She has taken loan from that bank and she has deposited into her bank 640 rupees. Now her bank also will keep 20% as cash reserve ratio, that is 128 rupees. And if you minus 640 minus, and then 640 minus 120, you find 512, that is 512 rupees has been kept, and so on. It goes on until you find it becomes zero, and here you find the total will be 5000. The total will be, so total of deposit will be 5000. In that, bank try to keep 20%, that is 5000 into 20%, 1000 rupees, and the minus it, so you get 5000 minus 1000, the 80% of it, that is 4000 as new credit. So supply of money has how much? 4000, out of how much? The primary deposit is 100. So you find that this is how the circulation of money is been given, or it has been done. So it's not complicated, it's very easy. The 20%, everyone, those who are there, will keep 20% with them. Every bank will keep 20%, and remaining 80% is been given as a loan. So this is how it works. I hope you have been very clear with this. Now the fifth point, that is interbanking transactions. We have seen that many a times when banks are in shortage of money, they try to get loan from the near bank. So one other bank will help them. So bank provides short term or long term credit to one another from time to time. Whenever there is a requirement of money, another bank will help the bank. So this is how. So short term credit is been provided by one bank to another through the central bank is called as what? Call money. So what is call money? When one bank is giving money to the another bank for a shorter period of time with the approval of central bank, that is called as what? Call money. Now the rate of interest which is been charged, that is called call money rate. So these are the five primary functions of, we can say, commercial banks. Now let's look into the secondary functions first. In that, agency and utility services. Now agency means what? Agency means here they are acting as an agent. So bank provides various utility and agent banking facility to its customer. Like it acts as an agent also, it gives different utility, like useful purposes also. Now let us see. First, bank act as an agent. It becomes an agent. How? By providing letter of credit to the exporter, by giving letter of credit to the exporter on behalf of importer. So importer want to import the goods. If he does not have the money, or he is able to pay money, but he requires someone to take guarantee. So bank takes that time as a guarantee, or becomes an agent, and it writes a letter, that is letter of credit, and it gives to the exporter. Then after, you find bank provide underwriting services. Like whenever you find that new firms which came into the market and they have issued shares in the market, but the shares are not purchased by the public. Like some of the public have purchased, some public have not purchased. So that remaining shares, what will happen? They need to be purchased by a bank. So that bank will be purchasing the remaining shares, and this new firm will give them underwriting commission, because they has taken as an underwriter, or they have taken as a guarantee. Bank has taken a guarantee that if your shares are not purchased by general public, that they will invest in your firm. So this all things are being done by bank. Then banks give facility to their customer to pay tax challans. So every end of the year you find you have to pay tax, and that tax challan can be paid by the businessman by help of bank. Then after, you find that bank provides safety deposits, or we can say locker rooms, on rent where customer keeps precious jewelries or documents or gold. We can say that many of them have different jewelries, gold ornaments, different ornaments, diamonds, etc. So people with that luxurious comfort living, they try to keep their all this particular jewelries into the locker room so that makes them feel that it is safe. And this, for this locker room, we have to pay certain rent for this locker rooms. So you find that customer have to pay that rent, and they will feel safe that all that particular documents and jewelries are safe into the bank. Lastly, bank provides microfinance. Microfinance means short amount of money to the very small businessmen. Different small businessmen, who those who required, they gave them very small amount of finance also. So these are the secondary function in the first point, that is agency and utility services. Let's talk about the second one, that is provide various facility with changing times. As the time has changed from handwork to digital work, you find that what other things have been changed. First, electronic transfer of money can became very easy. So the account from one customer, if you want to transfer the money from one customer account to another customer account, it can be done with the help of two things, that is NEFT and RTGS. Yes, NEFT and RTGS, which we have studied in the 11th standard OC. Then after, you find that customer can get various account details. If they want to know about their accounts and their details, they can use by internet, by mobile applications. Like bank has created their own applications, and every data has been kept, and it has been installed, which has been connected their server, and all the informations you can know with the help of this banking apps. Thirdly, bank also provide facility of demat account. Now, what is demat account? Demat account is dematerialization account. Now, it is an account which help us to purchase the shares, the debentures, the bonds, or different securities in the physical, not in the physical form, but in the virtual form, in the electronic form. So this will convert into electric form, and that is been credited, or it has been shown into your demat account. Like how we are keeping our money into the bank, and it has been shown on mobile application. If someone has deposited, or if we have done payment, it has been gone. So you find that same way, if you want to purchase shares, if you want to are invested in stock exchange, and you want to purchase share, debentures, bonds, that time you have to have demat account. It is very compulsory for trading shares and debentures. So one must have demat account, that is dematerialization account, where you find that physical share, bonds, or debentures are converted into electric form, and it is been shown, listed in your demat account if you have purchased. So these are the different facilities with the time to time where bank has given to the people, so that it becomes very easy for transferring, for purchasing, for trading purposes. So this is how it works. So these are the common or different functions of commercial bank. One is the primary function, and we have seen the secondary function also. I hope you have been very clear it. Now today you have to learn this, memorize it, you go with the notes. If you find any difficulty anywhere, just message, call. I will help you out with clearing all your doubts, queries. And next class will start with the central bank. Thank you.